Imagine this. You check your bank account. There's 1,284 in it. Rent is due in 5 days. Your credit card balance is 3,700. You have zero investments, zero passive income, zero financial cushion. And you scroll through social media and see people talking about retiring at 35, seven-figure portfolios, and financial freedom. And you think, that's literally me. I'm starting from nothing. Look, I've been there. No rich family, no inheritance, no startup exit, just a paycheck, and this quiet belief that there had to be a smarter way. And here's the thing. Financial freedom is not about how much money you start with. It's about what system you build. Introduction. My name is Peter, and I spend way too much time thinking about long-term investing and financial freedom. If you're someone who feels like you're behind financially, living paycheck to paycheck, or wondering if it's even possible to build wealth starting from zero, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today, I'm breaking down exactly how I went from zero to building a long-term investment strategy designed for financial freedom. Not flashy, not sexy, not crypto guru energy, just math, psychology, and discipline. And I promise you, this is going to challenge what you think it takes to become financially free. Part 1, the lie most people believe. Let's challenge something right away. Most people think, I need to make more money before I can invest. Sounds logical, right? But here's what most people don't realize. According to data from the Federal Reserve, nearly 40% of Americans would struggle to cover a $400 emergency expense without borrowing or selling something. Now pause. That's not because 40% of Americans are lazy. It's because they don't have a system. And here's another uncomfortable stat. Research from Vanguard shows that the average long-term annual return of the U.S. stock market has historically been around 8–10% per year. That means wealth doesn't require brilliance. It requires time. But psychologically, we hate time. We want acceleration. We want shortcuts. We want 10x returns in 10 months. And that mindset is exactly why people stay broke. Part 2, the psychological trap that keeps you at $0. Let's talk about behavior. Because money isn't a math problem first. It's a behavior problem. Here's what usually happens. You get a raise. You upgrade your lifestyle. You tell yourself you'll invest next month. And according to the Bureau of Labor Statistics, higher income households spend significantly more on discretionary expenses, not just essentials. Translation: as income goes up, expenses go up faster. This is called lifestyle inflation, and it's the silent killer of financial freedom. Now you might be thinking, okay, Peter, cool. So I just need to spend less? Not exactly. Because extreme frugality usually fails. Why? Because humans aren't robots. We are driven by dopamine, social comparison, and identity. We don't just spend money for utility. We spend money for emotion, status, comfort, validation. If your strategy ignores psychology, it will collapse. So the real solution is building an investment system that works even when you're imperfect. Part 3, the math that changed everything for me. Let me show you the math that completely rewired my brain. Imagine you invest $500 per month. That's $6,000 per year. At a conservative 8% annual return after 10 years, about $91,000. 20 years, about $295,000. 30 years, about $745,000. 35 years, over $1,000. That's not hype. That's compound growth. This is where it gets really interesting. In the first 10 years, your money barely moves. It feels slow. It feels pointless. It feels like nothing is happening. But after year 20, the growth starts accelerating dramatically. Compounding is like pushing a giant snowball uphill. At first, it's exhausting and slow. But eventually, gravity takes over. And here's what most people don't realize. The hardest part isn't investing. It's surviving the first 5–10 boring years. Part 4, my 4-step long-term investment strategy. Now let me walk you through exactly what I did. No complexity. No 47 income streams. Just structure. Step 1, build a 6-month emergency fund. Before investing aggressively, I built a 6-month emergency fund. Why? Because volatility destroys emotional stability. If the market drops 30% and you need rent money, you will sell at the worst possible time. An emergency fund isn't about returns. It's about psychological protection. Step 2, Invest automatically into broad market index funds. Look, I don't try to beat the market. Why? Because according to research often cited from S&P Dow Jones indices, the majority of professional fund managers fail to outperform the S&P 500 over long periods. If professionals with teams and algorithms struggle, what makes us think we'll beat them after watching 3 TikToks? So I invest in low-cost, broad market index funds. Total market exposure. Low fees. Long-term holding. Simple. Step 3. Increase investment rate. Every raise. Here's the trick that changed everything. Every time my income increased, I increased my investment contribution before upgrading my lifestyle. If I got a $500 raise per month, at least $300 went straight to investments. I allowed lifestyle upgrades, but controlled. This prevents lifestyle inflation from eating the gap. Step 4. Stay invested through crashes. Now this is where most people fail. During downturns, fear takes over. In 2008, in 2020, in every crash, people panic sell, but historically, markets recover. If you invested during major downturns and held long-term, the returns were often extraordinary. Here's the thing. Volatility is not risk. Panic is risk. And if your strategy depends on feeling confident all the time, you will fail. Part 5. The freedom number. Let's define financial freedom. For me, it wasn't owning a yacht. It was this. If my investments could generate enough passive income to cover my basic expenses, I was free. If your annual expenses are $40,000, using the 4% rule, you'd need roughly $1,000 invested. That sounds huge, but break it down. $1,000 over 30 years at 8% requires roughly $700, $800 per month invested consistently. Not easy, but not impossible. And remember, you can increase income. You can reduce expenses. You can extend timeline. The formula is flexible. The discipline is not. Part 6. Why most people never get there. Now let's address the uncomfortable truth. Why do most people never reach financial freedom? It's not intelligence. It's not access. It's impatience. We underestimate how long wealth takes and overestimate what we can do in a year. We try day trading, crypto speculation, stock picking, options gambling, instead of boring consistency. Look, financial freedom is like going to the gym. You don't get abs in 3 weeks. You get them after years of consistency. Investing works the same way. Part 7. What I would do if I had to start again at $0. If I had to restart from zero today, here's exactly what I'd do. Cut expenses aggressively for 6 months to build a small emergency fund. Invest 10 to 20% of income immediately. No waiting for more money. Automate everything. Increase income through skills, not speculation. Ignore financial noise. No stock tips. No hype cycles. No get rich quick. Just process. Final motivation. Let me say something important. You are not behind. You are early. Most people wake up financially at 40 or 50. If you're watching this and you're in your 20s or 30s, time is your unfair advantage. Even small amounts invested early are powerful. And even if you're starting later, consistency still beats regret. Here's what most people don't realize. Financial freedom isn't about becoming rich. It's about buying back your time, the ability to choose, to walk away, to breathe. And that doesn't require genius. It requires a system. Call to action. If this helped shift your perspective, subscribe to the channel. Because I'm not here to sell you dreams. I'm here to show you the math and the mindset that actually works. Drop a comment below. How much are you currently investing per month? And if it's 0, that's okay. Everyone starts at 0. What matters is that you don't stay there.